So we have finished module 0. We've got some basic stuff out of the way, and now we're ready to start getting into this. So like I had said in module 0, I am re-recording these things for better audio quality. The information might change a little bit, but it's essentially the same stuff. It's been a while since I recorded those other ones, so maybe there's a little more information. Maybe I strip it down. I don't really know. We'll see how this goes. So we're going to talk about what the market actually is. And it really breaks down to a few things. This concept of an auction, which I will dig into more. The charts we're going to dig into more. With candles, we'll dig into them more. And why the candles are the shapes that they are instead of just memorizing shapes. And the two mechanisms that move price. So we'll talk about order books and aggression and fair value gaps and all that stuff later. We're going to continue to just build because we're finding that first principles area that we can build back up to. So we're going to try to set a good foundation of how we're actually going to look at these charts instead of having to try to come back and undo that stuff. All right. When we're done with this, I believe that you will be able to clearly articulate what the market actually is in a clear and concise explanation instead of just a description. And I think that right there is going to put you ahead of 90% of retail day traders just right there. Because we're going to look at things differently and it sets you on a trajectory to be able to actually understand what's happening instead of guessing and going off vibes and feels. So when we have this operating system running correctly for you, everything else is going to get a lot easier. So one of the biggest things is the market is a continuous auction. It's always happening. It's always moving. And we'll dig into who is a participant of that auction. The chart, by the way, it's just a record of that auction. It's just a receipt. So like I had said in module 0, it is a lagging indicator of what is happening by its very nature, because once it prints, something has already happened, even if it's a millisecond. And the chart is not the cause of anything, which I think people apply that to the charts. The chart doesn't do anything. The chart just keeps a record. And each one of these things is going to get its own section. So let's jump into this. What is a market? I want you to come up with that. I want you to try to think of something. If you don't think you can clearly articulate what a market is in one sentence, then you're trading something that you don't really understand. And that's fine. That's why we're here. That's why we're going to talk about stuff and we're going to build that understanding. This is where most retail traders stay at. Maybe they explain it the same way that I explained it to you in the last module and just left as is, right? A market is just a place where people buy and sell stuff. That's true, but for our intentions of increasing our skill and ability here, it's pretty useless because that is just a description. We are looking for an explanation. So it doesn't explain anything of how price moves, right? So by the end of this, I'm hoping that you'll have that very clear, concise sentence. Because then it, becomes predictive instead of just kind of vibes and feels. So, all right, I'll actually just give it to you. What this sentence is. A market is a continuous auction between buyers and sellers, and price only moves when one side becomes more aggressive than the other. That's it. That's the sentence. I'm going to say it again. A market is a continuous auction between buyers and sellers, and price moves only when one side becomes more aggressive than the other. That goes back to the crossing the spread and that 25-cent difference where somebody has to make that move. Otherwise, nothing happens. That is essentially what we're going to be digging into. Also, just understanding that right now, that basically answers what all of these paid courses that, you got to pay them a subscription, or you have to pay to have access to Discord to be able to then pay them to have access to the trading signals and all this shit. That pretty much explains everything that they're trying to fleece people for. What are the things we're going to cover? I'm going to do this in every module, by the way. We'll talk about the things we're going to cover, and then at the end, we'll talk about the things that hopefully you have gained from this that you didn't have before. So we're going to talk about the auction as the metaphor, the analogy that kind of fixes the struggle I think there is in the thinking around how markets work. And once you start seeing the markets as more of an auction, half the confusion is just going to go away because now you understand why stuff's happening. We're going to delve a lot deeper into the chart is the record and what the candles are representing within that record and how we can infer things from it and make future decisions off of it instead of relying on indicators, which an indicator, by the definition of reading the charts to then indicate what you should be doing, is a lagging indicator on a lagging indicator. So the chart's lagging. So by its nature, the thing that is bolted on top of it to make decisions about your trading positions on something that's already lagging lags behind that, because then it needs to take that information, consolidate it into something that it then tells you. That's why just throwing a bunch of extra indicators on your charts doesn't do anything but make things harder for you. The chart isn't the cause of anything. It doesn't cause anything. It doesn't do anything. It just keeps track. Every tick, up 25 cents, down 25 cents, up $1, down $1, whatever the per tick point or per tick dollar value is a trade or a series of trades that are happening between a bunch of people at the same time that just prints as tick up, tick down. Cool. And then the two mechanics of what makes a market move, what makes price move, I should say. There's only two things. It's not 5 things. It's not 10 things. It's not 6 things. It's 2 things. And we'll dig further into that, and that will help deepen the understanding. Common misreadings. We all do it. Everybody does it. I'm going to do it again on Monday or Tuesday. You're going to do it a bunch of times. It's fine. We just continue to try to improve by understanding what these misreads are, how we're falling into these traps, and then how to avoid them. And then we're going to just apply it. And we are going to try to do things in very casual language, so we're not over describing things, we're explaining things. Okay? So section 1 is the auction. This metaphor is going to do a lot of the work. I will talk about it a lot because it's a decent analogy to start with, or metaphor to start with, that we can then break down to its component parts, to its bedrock, and build back up the same way we kind of are going to keep doing everything for this first principles methodology that we're going to apply. I will also say, just to say this up front, when I started and I would watch somebody and they would talk like this, I'm like, dude, that sounds so boring. And I'm not the kind of person who is very non-emotional about things. Like I feel things. I feel things deeply. You know, I have visceral reactions to a trade that goes against me, or, you know, whatever the thing is that kind of gets you amped up, or frankly gets you excited about this. It was tough for me to then see people who are being very successful, and you are actually seeing like, oh my gosh, these are your live trades, you're making a ton of money. Talk about it like it's not emotional, it's objective, it's analytical. You know, we're just dealing with data and numbers. God, that sounds so lame and boring. It's not. You are still going to have emotions. We're still human beings. But being able to suppress that in this environment is important for you to be successful. And I said it before. I'm going to say it again. I'm going to say it again and again and again. This stuff is actually pretty easy. It's the emotional control that is going to take you from being unsuccessful to successful. I have not found any other way around it. So please understand, when I start talking like this, and as we continue to go and it gets more and more kind of analytical, it's not because I don't have emotions around things. It's not that I think you should not have emotions around things. I just have found that controlling those is the best way to be successful doing this and to make the best decisions. So just understand that. That's an important piece that we'll keep coming back to. And ultimately, I think that is going to be the difference between you being successful and not being successful. Okay, so we'll go through this. We'll go through this metaphor, and then we'll dig deeper. What I don't want is you just memorizing stuff. Okay, so got my little notes over here. I'm always looking at. So whether you've been to an auction, whether you've seen one on TV, you understand what an auction is. Well, here's the example. This is the analogy that I really like, or the metaphor that I really like, that I'll keep repeating, because it gives you something visual to kind of lock onto, or something that you have some familiarity with in an environment that you don't have familiarity to then go and apply. But we're not going to apply it as a blanket. We're going to use it as a tool to help us get to the point where we have a fundamental understanding of the markets. Okay? So there's an estate sale. Somebody died, all their shit's getting sold off. You and a bunch of other people there, you and two other people see this chair that you guys really want. So you got you, bidder one, somebody else, bidder two, somebody else, bidder three, or ABC or whatever. The auctioneer is not going to set the price. The bidders are going to. You guys are going to. Yes, they will probably start at some price just to get the thing rolling, but we're not going to worry about that. In this example, we're just looking at how the market works from the buyer's perspective. The seller perspective is just the opposite of the thing we're going to be talking about. So price is going to be whatever somebody decides to pay and the others don't. That's how you get your chair. That's how the auction works. If nobody bids higher than you, auction's over, you get that chair. You're stuck paying the price that you agreed to that nobody else is agreeing to. But that's you clicking buy right now. That's you clicking that button and crossing the spread to get the thing that nobody else is willing to click buy and pay more for. So we're going to walk through this. So you've got, say price comes in starts at $100 for this chair. And then you say, as bidder one, you're like, all right, cool. I'll pay, 110 or, whatever. You say, I'll pay 100. And then person two or person B or whatever says, I'll pay 110. And then person C is like, I actually don't want this chair right now. I'm going to wait for a better price. So they're out. So now it's just you and the other person. And so you say, yeah, I really want this chair still. I'll pay 125 for it. The other one raises it, so on and so on and so on. And as long as people are willing to pay higher, it keeps going, it keeps going, it keeps going until somebody says, no, that's too much for me. And they step back and there's one person left willing to pay that price. Then that's the person that gets the chair. So congratulations, you just bought yourself an antique chair. That is the entire price mechanism in action. Well, from the buyer side, and then it happens from the seller side the same way, essentially, and we'll get further into that. So there's no models, there's no fair value gaps, there's no calculations. That's just two people agreeing to a price and doing that transaction. That's just the seller agreeing to a price and a buyer agreeing to the price. And the buyer crossed the spread to buy that thing. Okay. So most people, when they look at the chart, they're going to mentally treat price like it's this ex machina price coming down from the gods, and it just apparates and it's there and it's this very nebulous thing. It's not some external force. It's just not, right? And we can see that very clearly. It's just two people or two entities, and it's just the residue or the tape or the receipt of a transaction that happened. That's all. It's the same way if you think about a state line or a border between two territories. That wasn't something that just happened. It was two groups of people that found a place where they were kind of done killing each other for territory. And they went, you know what? This is a cool line right here. I don't want to kill it. I don't want any more of my guys dying to push that line further this way. And this group's like, you know what? We also don't want to have any more of our guys killed by y'all trying to push price or push territory this way. So that line is just where they met and agreed. We don't see historically like the battles or the conflict that happened to create those lines. What we see now is the receipt of that, where the line is decided. So, okay. This is just a little picture of what we were talking about. So it's the same thing as the two axes on the chart that we talked about before, right? You have time across the bottom and you have price up the side. So over time, price moved up and moved up and moved up until a price was agreed on, it was sold, and the auction was over. So this happens millions of times a day between millions of different entities every day, all the time, 24 hours a day. It happens way faster than this. It happens way slower than this. It's back to Granny in a meth lab. If you're in the wrong auction, or some auctions you are not welcome at, others you are welcome at. As day traders, we are going to be dealing with smaller time frames and smaller wallets because we can't compete with somebody that's bringing, 50,000 contracts into a position. We just can't. So, see anything else over here I want to tell you? That's it. Yeah. All right. So this auction is never going to end, right? You got millions of buyers, millions of sellers. It's always happening. When price starts to move up, the buyers are willing to come up, right? They are being more aggressive. They are wanting chairs. They're wanting chairs. They're wanting chairs. And they have to keep going up and up and up in price and be willing to cross that spread over and over and over again because the sellers are not needing to hit the sell button right now. They have their market order in that says, hey, broker, I want this order filled when price comes to me. I'm not willing to come down. Price has to come to me. So they're more patient. So the buyers, and they're taking all of those market orders from these sellers until they hit that seller. And then the seller goes, there's your chair. And the buyer goes, thank you, and walks away with their chair. Price moves down when the opposite happens. When sellers are going, click the sell button, click the sell button, click the sell button, and the buyers are saying, I don't need this chair. I want it, but I'm not going to pay more than X for it. So if price comes down to me, broker, go ahead and fill my order to buy that chair. So the sellers are more aggressive than the buyers. So they're looking for prices, looking through the range of price to find somebody willing to buy. They have to cross the spread. That is the futures market. That's crypto. That's stocks. That's any market where this transaction is happening with these two mechanisms, people buying, people selling, entities buying, entities selling. So I would encourage you to pull up your own chart and find something, just anything, and go through this with me, but I'm also going to do it here too. So let's walk through this chart without saying things like the trend went up. Instead, we're going to say something like buyers paid an increasingly higher price to find willing sellers, and sellers eventually ran out at X level. That is an explanation. That is not a description. So if I were to have said, well, yeah, price came up here and then resistance held at this level. So then price fell. It was rejected here and fell to here before it hit a level of support. Like, okay, kind of, sort of, yeah, useless. for actually understanding. Instead, let's talk through this. So what you can see here overall in this section here, you had buyers that were consistently more aggressive than the sellers. Oh, let me get my little thing out again. Sorry. Through this section here, what you can see is overall over this period of time, predominantly buyers were more aggressive than sellers. So you can see here, it's a lot of competition both directions. So there's not a lot of price movement because there's a pretty equal amount of buyers and sellers. So when people come up to buy, there are sellers sitting around these levels that are willing to fill those orders that are about equal to the buyers. So that's why price doesn't move a whole lot here. At this point on this candle, there was a shift for some reason, which we'll get into later, where there are more buyers now than sellers. So these sellers have run out. They ran out of chairs. They had to go back to the warehouse to go get more chairs. But buyers still want to buy chairs. So now they have to be willing to cross the spread. Every person has to be willing to spend a little bit more than the previous person to get a chair, because there's only one chair, in this example, at this price, and then one at this price, and then one at this price. So if I want to buy a chair and there's somebody who wants to buy a chair who's got, who's in front of me in line, they're going to get that chair. And then I am forced to pay the higher price for that chair. And the person behind me has to pay a higher price for that chair until we reach a place where there are more sellers with a bigger stock of chairs that can supply the buyers that get to here at this price level. When that happens, these buyers are going, thank you, I'll take my chair, and leaving. So then the momentum of that buyer action needing to go higher and higher to find a seller begins to reverse. This is a fair value gap right here, and we will talk more about that later. So this is an expected thing to see, is where sellers are going to then push price back down until they find more buyers to absorb those chairs they're selling. And at that point, you have found more buyers willing to buy chairs that now exceed the amount of sellers who have chairs to sell. So then the buyers have to be aggressive again and say, okay, we will cross the spread again because we still want chairs. So they buy more and more chairs, and they keep filling those orders for those sellers keep filling those orders until it reaches a point where all of the buyers run out. Then the sellers step back in and say, we have more chairs. But now the buyers have all gone home with their chairs, so they have to come back down to find those patient buyers who are willing to buy chairs here. And then guess what? They run out of chairs to sell. So the buyers have to become aggressive again. I mean, it is literally like these are the two mechanisms, and it's back and forth, back and forth, back and forth. That's everything. So here you see that there's price. There's not as much price movement, but there's a significant amount of battle over that price between buyers or sellers in this area because of those wicks. Remember, we talked about when you have a wick, what that's saying is price moved during this block of time, whatever this candle represents. It's a 5-minute candle, let's say. Price moved all the way up to here before sellers came back in aggressively and shoved that price back down to find buyers. And it continued all the way down to here until all of these sellers that were looking to sell their chairs all sold their chairs off. And then there were buyers that were sitting below that line that said, we want chairs again. So they start looking for chairs, and they have to pay higher and higher and higher prices. And then this is where that 5-minute candle closed. Then you see this significant drop in price. There's another fair value gap here. We'll talk about that again later. This is very clearly sellers being significantly more aggressive over this 5 minutes than buyers. They had to come way down on what they were willing to accept for their chair to find people to buy their chairs. It continues until you find what we would call in the shorthand, which we'll use the term, but we have to be able to describe it, or explain it, not just describe it. This area right here, we would call a level of support. What that means really is that there are a significant number of buyers that were hanging out here patiently with market orders waiting to have their order filled when price reached them. So these sellers were the ones clicking sell now, sell now, sell now, sell now, sell now. And now all of these orders are getting filled here. They run out of their chairs. They got to go back to the warehouse. And in the meantime, the people that didn't get their chairs that were hanging out around here now have to become aggressive and say, I am willing to spend more. I'm going to click buy until we reach a level where we find sellers that are being patient and they have market orders that say, hey, when price comes to me, I don't need to sell my chairs right now. I will sell when the buyers come to me. And it happens again, and it happens again, and it happens again, and again, and again. And you can see this area right here. You'll hear different phrases. The market's flat. It's ranging. It's in a range. Basically, what this means is even though on this 5-minute chart, it looks like there's decent price movement, and there is. People are making these transactions back and forth, back and forth, back and forth. But if we zoom out to an hour, first of all, this is only going to look like, a candle or whatever, 2 candles. But what we can say now is like, okay, we have pretty clearly established a range where price is bouncing back and forth. So you have this group of sellers and this group of buyers that more or less generally kind of agree that this is the fair market value for the chairs for this amount of time. Now, this is obviously going to move eventually, but for this block of time on our x-axis, people are agreeing on the y-axis that this is the reasonable price range. This happens before this happens typically. So it probably happened over here, and then it came out of that equilibrium and then returned to a level of equilibrium. So I know I probably said some of this, trend and buyers paid up. I don't mean to. I'm trying really hard to go back to explaining it foundationally like this, but I hope that helped. All right. So again, charts the record. I think this is probably the most important reframe in this whole module. I've done it too. I still catch myself saying it even though I don't mean it, but I give the chart agency. People give the chart agency. I think deep down, a lot of people, until they really fundamentally understand what's happening, really do give agency and almost anthropomorphize the charts as if the charts are out to get you or they're on your side or, the chart itself is the thing that is causing other things to happen. I think people really do believe that. Like the candles themselves are doing things like the whole, price wants to go up or support is holding. Those are descriptions of things that you were looking at. Charts of the receipt, they're just a printed record of decisions that were made by participants buying and selling. So once you really, really internalize that and you really understand it and you start reading what's happening instead of giving agency to this inanimate stuff, I think you're going to do a lot better because you're not trying to outsmart it and you're not going off of like gut feel and vibes. You can make a lot more rational decisions and you can be a lot more successful and like more consistently correct. So whether you have already been involved in this in some form or fashion, whether you have already fucked around and been on YouTube and watched some of these gurus or whatever, most of this education that you're gonna have out there is gonna say some stupid shit like somebody's gonna be like, you just read the chart and the chart will tell you what to do. That sounds like super neutral. It's fucking not. That is implying strongly that the chart in fact does have agency, which it does not. It's not gonna tell you shit. It's not a fucking magic 8 ball. It's not, it's not a crystal ball you're ever reading. It's just information to make a decision. So the indicators are not your signals. The candles themselves are not your signals. You have to decide what the signal is going to be and not let it just come to you, right? So what's actually true? The chart is a receipt. Some people or some entities did some things back and forth. And The chart is a record of those transactions. No agency to it. Candles don't have any effect on anything. They don't cause anything. People do. So thinking about it this way is really going to help develop you as a trader who is actually understanding the markets, reading participant behavior, and making decisions based on what you are inferring instead of what something else tells you to do. So if you're saying something like, yeah, I'm just going to go in and I'm reading this chart right now, that's fine. But what you should mean when you say that is like, I am inferring participant behavior based on the price action that I am seeing. That's a much harder skill. It's much harder cognitively. But it's the only thing that actually generalizes. And by generalize, don't mean like make it, really kind of, it's super general. It's super generalized knowledge. No, it means that you can generalize what you're looking at. So instead of saying I can only understand, or I only think that I understand what's going on in this very specific context with this very specific symbol and this very specific time frame or whatever, you can apply this around the markets, right? So if you do decide that you would rather trade crypto or bonds, you should be able to with the actual knowledge of what's happening, because people are people everywhere. So if you can learn to read people in micro futures and you decide that you want to do something else, you should be able to apply this knowledge generally to other things. So like I said, much harder skill, but once you start reading this, you will be locked in when conditions change that would otherwise fuck you up, because you actually understand what's happening. That's like when I first started and I would be watching somebody and they would do something that I liked and I thought was interesting. And they would say, okay, well, I'm looking at the chart and it's explaining this and this and this. And so you do X, Y, Z. That is my system. That is my trading thing that I've named after myself. This, X, then Y, then Z. And I'm like, okay, cool, awesome. And when I'm watching them explain, I'm like, yeah, that makes a ton of sense. And I would find myself thinking like, God, I just wish that they could sit with me and go through my charts as I'm doing it to help me understand, because it's not happening the same way on my charts. What's really happening, or what was really happening, is I was memorizing patterns. If you see this and then you see this, you do this. And it works until it doesn't. And because I didn't know fundamentally what was happening, I would just get frustrated and be like, well, why the fuck doesn't this work now? Like, this doesn't make any sense. It was working fine. And now it's not, because I didn't have generalized knowledge that I could apply to these different situations. So then what do? You're like, you know what? This is fucking garbage. This is bullshit. So then you move on to a different chart or a different person to learn from. And you use this extra indicator that somebody else recommended who also doesn't know what the fuck they're talking about on Reddit or something, who wants to sound smart, and you buy into it because you really want to understand this. And you're like, well, somebody else is explaining it. They must know what they're talking about. That's not true. There's tons of shit I don't understand. I'm not going to sit here and blow smoke up your ass and tell you I do, because I fucking don't. And I don't need the ego boost. I just want to be good at this and make money, so my wife and I can retire. Okay. So before you read this, I want you to ask yourself, what did the buyers do in this snapshot? How aggressive were they in what they were doing? And where did they pay up? Where did they decide they were willing to pay to? And then inversely, what did sellers do? Did they absorb price? Did they panic and you see a bunch of price movement? Did they just disappear? Were they just out of the market? And they're like, So these are important things to think about. So instead of just saying, what did buyers do? What did sellers do? Being more prescriptive in what we're asking is going to be more beneficial to us long term. So how aggressive were they? Where did they pay up? Did the book walk or lift one side at a time? Don't worry about that yet. We'll come back to order books because that's important, but I want you to hear that so that when we come back to it, you're like, oh yeah, I remember him saying something about that. So let's see, I'm just checking my little notes. When we're looking at this, I think we can agree overall, buyers were more aggressive than sellers over this time period. And this is a much bigger time period than what we were looking at before. depending on what chart we're looking at. 5-minute chart, hour chart, whatever it is. So instead of using the terms that were kind of forbidding, we had sellers that were more aggressive in seeking out buyers through this section, meaning that sellers had shares that they wanted to sell right now. They wanted to click the sell button. So they had to cross the spread, seeking out buyers that were willing to pay that price for their chair. So you have all of these aggressive sellers that are selling, and each time a chair gets sold, the person behind them has to be willing to pay or to accept a little bit less to fill their order, and then a little bit less to fill their order. So as they're walking down, people that were sitting here patiently said, okay, cool. I bought my chair at that price I'm comfortable with, and they're out. Then the next person says, okay, cool. I'm the next lower price I was willing to take it at, and they're out. And that keeps going. So you have, and then on the flip side, each seller has to get more and more aggressive than the last guy. Well, shit, man, he just sold his chair and he got out. Okay, so now I need to go down in price so that I can go out. And the person behind him is like, oh shit, okay, well, I got to accept less so that I can get out. And it walks down, and it's not aggressive. Nobody's panicking right now. That's a pretty mellow move. And then you reach an area where you have an excess of buyers that have collectively sort of agreed, well, like independently, but collectively have agreed amongst themselves without interacting with one another that this is fair market value that they're willing to, or maybe not fair market value, but this is the value of the chair to them that they're willing to wait at. So when these orders start getting filled with a diminishing amount of sellers, and you have a pool of buyers sitting at this price range, eventually they are absorbing these sellers who meet them at this point. This is the territory line, essentially. So when there's all of these sellers are out of the market with their chairs being sold, there's still an excess of buyers that need their chairs. So now they have to switch roles and they have to become the aggressors. And then you could see right here, this 1, 2, 3, 4. See how flat that line is? See how sharp that line is across there? That is something to pay attention to. This is what we would say the level of resistance. All it means is there is a decent pool of sellers that are hanging down at that point who are being more patient, that say, I will wait for price to come to me. So as the buyers continue to come up to them, they're absorbing those buyers. So price hits that level, and you have buyer and they leave, and buyer and they leave, and buyer and they leave. And you have more sellers here with chairs than buyers coming to them. So it exhausts the supply of buyers, and then the sellers have to become more aggressive. So then they have to seek a lower price. And then now that role has reversed. And you can see how tight this gets here between these like couple of candles. And you can see very clearly that there's a lot of contention over this price right here. This, especially those two, people are agreeing. The people that are participating in the market are agreeing that that is a fair market value at this point in time on the x-axis and the y-axis. As soon as that shifts, the sellers have to become more aggressive to come back and find a new level where buyers are collectively agreeing on a price. And then it moves again. And we see this go back and forth. So what's happening? This is pretty calm. This is pretty calm. And buyers are just holding the aggression. And then they get this point and they just explode up. What is that all about? If we think about it fundamentally, where we have an auction between buyers and sellers. My wife's snoring over here. She's been working her ass off. Between buyers and sellers, you have essentially two pools of people in each position, right? So if you had a bunch of buyers, if you have more buyers than you have sellers overall, when you get to this point here, the volume of sellers has been exhausted compared to the volume of buyers that are still in the market aggressively looking to buy some chairs. So everybody has been wiped out, or I guess all of the shares have been sold and all of those sellers have been satisfied and left the market until this point. And then there are no more sellers, or very, very few sellers between here and here. So buyers have to then very aggressively jam up to find that next group of sellers at the price that they are saying, we're comfortable waiting for you to come to me. So now we establish a new area of fair value. This little range here. See how hard that line is there? See how hard this line is here? So I'd said before in Module 0 that some people say wicks don't matter, and I'm like, they really, really matter. Here's why. So if you see this 1, 2, 3, you have these wicks that show that buyers drove price, or they chased price up into this zone. And at this level here, the buyers ran out. But there were more shares to sell. So you now have this area where you have found a decent group of entities willing to sell their shares, represented by the price movement back down to this doji right here. Which again, I said you don't really need to care what that is, but it's just, it shows you that this second candle here, there was so much aggression from both sides and price moved almost like not at all. But now what we have is, okay, so it started creating this line here. This is what we call a level of support. But what we're really calling it, what we should mean is there's a significant level of buyers at this price range that are willing to pay this amount and not more. And there's a lot of them. So price comes down and it hits that wall because there's so many people at that point that it's just absorbing. But you also have a significant level of sellers that are also sitting at this point right here. And they are agreeing that this little gap right here is fair market value for this time period. So they're just both firing shots at each other, or buying and selling. It's not confrontational, but people are bringing enough shares for the people wanting to buy them for a while, until what happens? The amount of sellers that were sitting right here have sold all their shares to the big group of buyers that were right here. At this point, it shifted where there were more buyers than sellers. So the buyers had to become aggressive and come up and find that next price point, which they found here where more sellers were sitting, that were then a bigger number than the buyers that were left in the market looking for their share. Now, the buyers or the sellers become more aggressive because they have satisfied more of these buyers than were still in the market comparatively. So then they had to come search price down. And I know I'm just like, God, I'm beating this to death, but there's such an important point to this. You can see here, and I'm just going to kind of like drop this and leave it, and we'll come back to it later. You actually can see here that this fair value gap that was established, a massive fair value gap. Think about what that actually is saying. It's not just FVG. Well, okay, I want to re-enter as FVG. Then you have blah, 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 blah. This is a fair value. This is fair value. This is fair value. This is a fair value gap. If you think about what those three words mean in combination, just kind of stew on that for a little bit and we'll come back to it. Price comes back here. We find more buyers that are more aggressive, and there are more of them than sellers. So then they have to jam up here to find a new level of sellers, and so on and so on and so on until we find a new level of fair value at the top here. See how little price movement there is. Hold on, I got somebody at my door. Okay. Are we back? Okay. Sorry, that was some fucking jackass on one of those little like rolly, not the one wheel thing, but the one where there's like a wheel on either side and there's like a little board between it and you just like lean and roll around. Coming to sell me shit at 9 o'clock at night on a Friday, dickhead. Anyway, let's go back to here. Okay. So you can see that not only do you have this overwhelming buyer push, you also within this probably have sellers that are like, I changed my mind. And they are going, and they're getting out of the market. So there's a lot of things that are happening here. I was very long-winded. I will keep being long-winded. I will keep addressing it, and I will keep not doing anything about it. But this is the kind of thinking that we want to get into, because it as you monologue to yourself, especially as you're learning, you're reinforcing all of these foundational things that you're going to need to be able to just look at and be like, okay, cool. Yep. Okay. I understand what's going on. And then move on to the next step in whatever your decision-making process might be. All right. So now let's get into these traps, these narrative traps, because what we think and what we say is important to how we interpret things and how we make decisions. So I know you can read, but let me just go through this with you. What most traders are going to say, uneducated traders that don't understand things from a fundamental level, are going to say something like, oh yeah, that trend continued, that bearish trend continued down, that bullish trend continued up. But what we should be saying and what we should be meaning and understanding really ultimately is what actually happened, which was, yeah, the trend continued, but that doesn't tell us anything other than a description of the thing. What happened was buyers in a bullish market or bullish run consumed every offer that was in that queue. We'll go to order books later, but essentially every chair that was for sale, buyers wanted, and they kept willing to be going up in price because they just really wanted these chairs. Oh, resistance broke there. No, it didn't. I mean, sure it did. Yeah. But sellers ran out at this level, then buyers that ran out that were coming up to that level. That's how price continues to move up. And like we had just seen, there was a level of fair value where you, for a time, had pretty equal buyers and sellers. And then the sellers ran out of chairs to sell, and the buyers had to keep pushing up to find the next group of sellers. That is what somebody would mean when, or would say for like resistance broke. That's given the chart agency. Chart didn't do that. There were more buyers. Price wanted to go up. No, price didn't want to do shit. Buyers were willing to pay higher for their chair. So the receipts showed that price continued to move up in response, or as a running tape of what those buyers were willing to do. Oh, well, that level of support held. Maybe, but you had a large group of buyers at a certain level aggregated that were willing to absorb every aggressive seller that came down to them. They were patient and they said, this is a price we're willing to accept, and there's a ton of people at this price. That's what support held actually is indicating. Oh, the market rallied off of that. Market didn't do shit. People did stuff. You had aggressive buyers that lifted multiple levels of ask levels, right? They came in and said, oh yeah, okay, we bought all these chairs, but we still want more chairs. There's still more of us that have exhausted this group of sellers. So we're going to keep looking for those sellers at a higher and higher and higher price. Oh, great. Well, it's like it was doing this and then buyers stepped in. Okay. There were new limit bids that were appearing faster than the asks the sellers could fill them. That is what kind of, we'll come back to that with the fair value gap situation. That is kind of a visual representation of this happening. Buyers stepping back in faster than sellers could fill the orders that they're asking for. Left side, we're not explaining shit. We're just describing it, which doesn't do us any good as we try to understand things at a deeper level. Right side, this is mechanical. This is actually what happened. It is causal. We can appropriately infer things from this understanding, and it's real. It's not this nebulous kind of like, oh yeah, like the chart's doing shit. Nope. You got to be able to explain things to be able to predict what's going to happen next. If you can't do that mechanically, then you're just guessing and you're going off vibes and feels. So I'm sure you have come across somebody at some point in your life that just, God, they needed you to know how fucking smart they were. So they use all these big words and these technical terms. And yeah, maybe you're fooled, maybe you're not. But it's like, yeah, I know big words too, man. I just don't have to fucking use them all the time. Right? Because I'm not trying to convince you that I'm smart or I know what I'm talking about. I don't care. It actually takes a deeper well of understanding to be able to explain something technical very casually with normal language than it does to try to baffle somebody with your bullshit, right? Because if you're like, oh, I have all this vocabulary that I know you don't really know. So if I use all this vocabulary, I put myself in an advantageous position because you feel like I know something that you don't. That's chumps that are trying to be impressive and have little egos that need a lot of or big egos that need a lot of stroking, I guess. I worked with a guy as an example of the more casual end of this. He's an X-ray guy, and he's been around for 800 fucking years, and he practically invented the X-ray machine. And this guy has been all over the country. He's been all over the world. He has set up all of these different like IR like departments and cath labs and teaching X-ray schools how to do, like, the guy's like 800 years old and he's still doing this stuff. He knows so much about everything IR, everything X-ray, everything. I mean, it's CT even just from osmosis, but you would never know because he talks about things really casually. He's just like, oh yeah, it's just kind of this thing or that thing. But you understand very quickly that this guy is taking some wildly complex technical things and is able to reduce it down to a level that I can understand, because I don't know shit about any of that stuff. Like, I know you shouldn't stand in front of an X-ray machine unless you are getting an X-ray. I know it's not great for you. I know that when I got a vasectomy, I chose to stand in front of the X-ray machine every time because I want to make sure fucking the vasectomy took. Is that sound judgment? Probably not. But anyway, the point of that is, if you can really break something down to where anybody can understand it, that is the sign of somebody who actually knows what the fuck they're talking about. So, just beating this to death. If we have a description of something, which is the whatever who cares version of it, well, that trend reversed. Yeah, if you go in the market and you're looking, MNQ had a trend reversal today at about 6:20 a.m. right at the New York Open. Moved so many points and da-da-da. Cool, man. Good for you. But you can say, hey, look, man. When you look at this chart here, you can see all these buyers ran out at this level, and then those sellers had to become more aggressive to come find new buyers. I have to use a bunch of fancy ass terms. I didn't have to try to baffle anybody, but it's because I actually understand it, so I can take the concept and I can generalize it to be able to explain this to somebody. Yeah, well, if you look here, you can see the price broke through resistance at this level. Okay, so you have an aggressive group of market buyers that continue to consume patient sellers that they were coming up against, and they were finding at a price level, and they kept aggressively buying. Therefore, they ran out of sellers at that price level to buy their chairs from, so they had to seek price higher to find new people to buy chairs from. We can look right here and you can see the support held. There was a big pool of buyers sitting at that price level at that time, and they just continued to absorb all of those aggressive sells that were coming up, or sorry, down, right? You had a large group of buyers at a level that they were comfortable waiting for price to come to them. And there were so many of them that everybody that was wanting to sell a chair that had to come down to that price was being absorbed until there were not enough people. There were no more people selling chairs aggressively anymore. And then it leveled out. Now, if you can look here with this indicator they have on this volume indicator, you can see the volume actually confirmed that move. Okay. So you had a prediction on something, say for a long position. All right, cool. So if I'm looking at this and I think price is going to go up, as it went up, you can tell that that happened because there was more volume. There were more people who were willing to buy than there were people that were willing to sell. So for these buyers to get their chairs, they had to aggressively cross the spread and be willing to pay a higher price each time until their order was filled and they ran out of buyers that outweighed the amount of sellers. We could tell here the market was nervous. So there was uncertainty in the market. The order flow went back and forth. People kept changing positions. People weren't confident about a price level. So they reacted to that. They made decisions based on that. And that shows as inconsistency in the orders being filled. That makes sense? I don't know why I asked you that, like you can answer me. Okay, so first of all, what's a tick? A tick is the smallest denomination of price movement that you can have on any given chart. So it could be 25 cents, it could be 10 cents, it could be $1. And so many ticks make up a point. So when we say a tick, I'm talking about the smallest value shift, the smallest spread that you can have. We'll call it 25 cents because that's what we've been using a lot. So to see these ticks, by the way, you're gonna have to zoom like way, way, way in. And that is where we have to be. We have to be so granular to understand this stuff. And what we're actually seeing is individual transactions. And they happen fast, depending on the time of day and who's involved in the market. Trying to move my notes here. So yeah, we're going to dig into this. And as we zoom in, you're going to see all the stuff that's actually hidden in there that a line chart will never show you. And a larger view of that same thing isn't going to show you. So that same chart. So what's the transaction look like? Well, this kind of goes back to our metaphor for the auction, right? Inside every single tick, every single transaction that happens, you're going to have a buyer who wants in, and you're going to have a seller that wants out. I would like to buy something. Cool. I would like to sell something. What's the price we're going to agree on? Okay, here it is. That's the price we're going to agree on. Seller sells, buyer buys. Both of them are leave the market for the time being because they have completed the transaction that they wanted to complete. This can only happen when two sides agree. It also means that somebody has to be the aggressor. Always somebody has to be the aggressor. Otherwise, we have a flat line. Somebody has to cross that spread of that one tick for something to happen. It has to happen that way. Let's see, what else do I have? So yeah, every single candle you see, every single slice of time that you see, down to milliseconds, this is happening. Every day, all the time. Across every symbol, every market, everything. Anything else I want to tell you here? No, not really. This is just price action. This is the atomic level of things acting on one another, people acting on one another, that create the receipt that is the chart. So, like I was showing you, as price moved up, or you saw price rising as the result of buyers having to look more and more and more, look further and further up the dollar amount to find somebody who was willing to sell them, who was chilling and waiting for price to come to them. So everybody who wants to buy a chair needs to pay a little bit more than the person who bought the chair before them when there's an imbalance between buyers and sellers and there's not a fair market value established. And even then, at every single transaction, at the most microscopic granular level, every interaction back and forth is this. So you can look at a series of candles and it looks like you have a whole bunch of candles showing bearish movement. And then you have a bunch that are showing bullish movement. And overall, you're seeing kind of an upward trend, right? You can see overall buyers in this time period have been more aggressive than sellers overall. And then you zoom out a level and you go from looking at a 1 minute chart to a 5 minute chart. All of a sudden, it's just showing you a bullish candle because it's compressing that granular interaction, that one-to-one transaction into something easier to manage, something easier to see. So you lose the fidelity when you start stepping up. Okay, so buyer pay a higher price. Why? The previous offer was consumed by the person in front of them. And why? Because somebody had to be aggressive and cross the spread because they wanted to hit buy right now. They weren't willing to wait. As soon as those buyers that are in the market stop being willing to be aggressive and cross the spread and they get patient, that movement up stops. Same thing with sellers. The seller is going to have to accept less than the guy before him, because that prior bid got hit. I'm chilling. I don't need the chair. All right, fine. Boom. All right, I'll buy it now. I'm chilling. Okay, fine. Come down. I'll buy it now, right? And that is because somebody clicked sell because they wanted out right now. They're willing to cross the spread to get out. As soon as they stop being willing to take a lower price for their chair, that downward movement stops. This all is predicated on consent. Every single time a transaction happens, price moves in one direction or another, it is because two parties consented to a price. So this is just a 1 minute chart. Go in there, pick something. This is where you go into this high fidelity, and then we'll just walk through this. Okay. Were the buyers willing to pay more, or were the sellers willing to accept less? We're just going to do this kind of as a run because this is getting long and we're halfway. So right here overall, you had buyers that were willing to pay more than the previous buyers until there were no more. Until there were no more buyers willing to pay more at this price because they all were filled here. So then everybody else patiently said, I'll wait for price to come to me. So then the sellers had to get more aggressive. The people that wanted out right now that hit sell filled that order. So they have to accept a lower and lower price to find buyers willing to buy who are being patient. You have this little area where there's a little bit of a pushback where you start to maybe run out of some sellers at this level, or hit a bigger pocket of buyers that kind of stall this out and they agree on this price here for a minute. And then that little pocket of buyers is then overwhelmed by incoming sellers at this price that want to get out, right? So we see all of this coming down to this floor where you have a significant amount of buyers that outnumber the aggressive sellers. People stop being aggressively trying to get out, stops moving, and then it goes the other direction. The buyers become more aggressive. There are more of them. They're willing to keep crossing that spread to find patient buyers that are willing to sell them chairs. You find another area temporarily of fair value where there's consent and people are generally agreeing that the price range is right in here. But if we zoom in even further than this 1 minute chart, then we can actually go and see on a 10-second chart all of the interactions that are making this candle up. And then you can go further down until you're at these milliseconds. That's all that's happening. All that's happening. Only two things that move price. Only two mechanisms that do it. We've already talked about it a lot. The entire repertoire is 2 things, not 6, not 12, not 10, 2, right? Sometimes milliseconds, sometimes months. You can already name that mechanic. I know you can, just from paying attention to what we got. Every other piece of trading analysis gets so much simpler when we say you can only buy or you can only sell. That's it. There's only 2 things. Everything else beyond that is a description of how and why that happened, or why people felt that way. Okay. Mechanism number 1. You have buyers who become aggressive. They want to buy. So mechanically, what that means is buyers cross the spread. They consume offers in the queue, and we will go much further into this, but this is kind of a simulated order book. So we'll talk about the order book later and what that actually represents and look at it in real time and all that stuff. But this is basically shows you orders at different prices. And this is our point in time or leading indicator of what could potentially be happening based on where these market orders are sitting. These do not represent click buy. These represent market orders of I'm going to wait. And these would be the sellers in this case, right? So buyers are running up through this price because their order in the queue, the person ahead of them is satisfied. So it's their turn. So they have to pay the higher price. They have to pay the higher price. Okay. So, buyers are continuing to cross the spread because they're more aggressive. They consume an offer. They leave the market with their chair. And then the next person in line has to accept a higher price or leave before they get their order filled. Person behind them, and as long as there are more buyers aggressively looking for price higher and higher and higher because they're willing to pay more, they will continue to do so. As soon as people stop willing to be doing that, price stops rising. I don't know why there's a down arrow for price rises. I don't know. Also, the way it works, it's not momentum. You'll say momentum, but that's shorthand for later. Nobody's stepping in. It's just somebody going, all right, cool. I'll pay more than that last guy because I want my chair. Exactly the same in the opposite direction. When sellers are more aggressive, because this is the only other thing that you can do, they are moving through price levels to find willing buyers who are being patient. These are the market orders. These are not the click, sell, click, sell, click, sell, click, sell. The click sells are what start moving through this. One guy grabs a chair here. Another guy grabs a chair here. Another guy grabs a chair here at a lower and lower price. Or I'm sorry, sells, so they're selling. Okay. That's the whole thing, man. Anything else? Patterns, trends, market sentiment, volatility. It's all just this. It's just people buying and selling. Super simple. So in action, let's look at that chart again. This might be a different one, but irregardlessly, here's a strong run, if we want to call it that, to here, and then there is fair value established here, and then price goes bullish again. It's not how we talk about it, but that's how you'll hear it be talked about. So I kind of go back and forth. So we can say, like, when somebody says something that is just a description, that we can understand what it means. Okay. Buyers are willing to pay more through this section here with a little bit of seller aggression at a couple of points. Buyers found an area where there were not a lot of sellers. So they had to cross a lot of price points to find more sellers. And then at this point, buyers and sellers fought over this territory here. X-axis, Y-axis. Until the amount of sellers at this price level was exhausted. They had they filled their sell order, or they just got out of the market for some other reason. and there were still more buyers, and now there were more buyers than there were sellers who then have to go up through and find willing sellers again. And that's it. Same thing in the other direction. Overall seller aggression throughout this whole process. You can see areas where there was some buyer aggression, but overall, if we were to zoom out, this would just be a series of bearish candles. And we get to this point down here where we find buyers and sellers had come to a point of fair market value in this at this particular time, at this particular price level, with fluctuation in between. And you can see here as an example, and here as an example, this looks like a weekend. Probably it's probably like this is probably Friday at 3 p.m. and then this was probably Sunday or Friday at 2 p.m., Sunday at 3 p.m. So you see that drop like that because that was transactions that were happening when the market was closed. Anyway, you can see where there were a lot of buyers that absorbed these sellers that were aggressively pushing down into this price range. Buyers didn't step in. Sorry. There was a pool of buyers here that were willing to absorb those sell orders until the sellers here became exhausted. And then the buyers had to get aggressive and cross the spread to find more sellers. You have another level of, I'm doing it again. I'm sorry, guys. And then you've got another kind of area of fair value here, another area of fair value here. And then here you can see another area where a large group of sellers had been exhausted and it was real thin between this point and here for sellers who were patiently waiting for price to come to them. So the buyers had to get really aggressive to go find more sellers at a price point that were willing to sell to them. Beyond those two mechanisms, everything else is extra. And it's just a description of the transactions. Every other label you've heard. Trends, ranges, breakouts, reversals, flags, wedges, double tops, head and shoulders, dojis, falling stars, hammers, all that shit are just descriptions of an amalgamation of individual transactions happening. All of that is just a pattern of the mechanisms 1 and mechanism 2 happening together in a sequence. Letters to words to sentences to paragraphs to novels. So when you hear, oh yeah, it was an uptrend, that was just a whole bunch of transactions between entities that were more heavily buyer aggression. Oh yeah, it was in a downtrend. It's been running bearish for a week. That is overall a series of transactions in which sellers were predominantly more aggressive than buyers. Oh, it's been ranging all day. Oh yeah, it typically ranges around this time of day. Neither side is dominating. They have effectively agreed, buyers and sellers, that they have found a fair market value for the time being. So price just Oh, there was a breakout after the news or whatever. One side just became more aggressive than the other side because there were more people willing to buy more chairs than people willing to sell chairs at that price. There's just the two things. Everything else is a description of a pattern of those individual transactions. This stuff gets misread all the time. There are traps. And again, like I'm going to fall into them. I'm going to keep falling into them. You are going to fall into them. But this gives us the opportunity to try to work through that and avoid some of those. Trap number 1, and this is the big thing, is I really, really don't want you guys over relying on indicators ever, but especially not now, because you're going to reach for things that let you bypass understanding. They don't actually tend to help you a whole lot. They make you feel better because you can offload the responsibility onto this other person who told you to use this indicator. So when you start overlaying RSIs and triple EMAs and MACDs and removing averages and XYZ and a million other things, you aren't really understanding anything. You're not seeing the order book. Like I had said before, since the market is, the charts are a receipt of what has happened in the past. Your indicators are by their very nature going to be lagging as well. So they aren't going to tell you what's happening right now. They're going to tell you what happened, and then they're going to tell you what to do for something that hasn't happened yet, which you can't actually know based on this information. An indicator can't tell if buyers are going to now get more aggressive and pay higher, or they're going to give up. Every indicator is mathematically, it's just a description of what already happened, right? If the indicator says it's overbought, that's going to happen after buyers have been paying up into it for a while, whatever the thing is, the shares, right? Mechanically, it can't tell you if buyers are going to keep doing it or not. So, and that's why these indicator-based strategies tend to like whipsaw back and forth, is because it's this, you're behind the blocks all the time trying to catch up to what's happening. So what's the better way to do it? Read the fucking charts by way of interpreting buyer and seller behavior, because it can only do two things. That's how you do this. You don't need a fucking indicator. You can use indicators to make your life a little easier if you understand why that indicator is doing exactly what it's doing, and you can do it without that indicator. Okay. All right. That good? Did I do trap number 2? Okay. This is another one you're going to use all the time. I say it. I mean something else by it, but it's shorthand. The support held, resistance broke. So like support or resistance held, support resistance broke. That is just a generalized term, a name that we are overlaying on a price point where a bunch of entities are clustered together agreeing that this is a price worth paying attention to. Good label, not a good cause. Well, resistance held. Okay. That was really strong resistance that there. Okay. There were a lot of sellers that were sitting at that point patiently waiting for buyers to come to them en masse, and they were able to absorb those buy orders because there were enough of them that they satisfied the buy orders. And when the buyers and sellers were satisfied and left the market because their transactions were completed, at the end of that, when there were no more buyers, there were still sellers sitting at that price level, patiently waiting. So now you don't have buyers aggressively moving up in price. So now you have new sellers who want to get out of the market now, and they're willing to cross the spread to seek price lower to where there are now the remaining patient buyers. Nothing holds, nothing breaks, buyers absorb, and sellers run out of willing absorbers. Okay. We're getting there. Stick with me. This is important stuff. You can take as long as you need to with this. This is a big one. Description is not causation. Description is not explanation. Well, the volume there confirmed the breakout. Well, if it didn't do what you thought it would do, or what you're saying retrospectively ad hoc that it was doing, or post hoc, sorry, then you would have said something else, right? Like, well, it confirmed the breakout. The volume confirmed the breakout. Yeah, it's just because it already did it. Otherwise, you would say something like, it was invalidated, or the trend was wrong, or whatever. It failed the breakout. Okay, that's you just saying some shit that who cares, doesn't mean anything. Well, that pattern played out as expected. Same fucking deal. That's the tautology, right? Like, if it didn't do that, the only reason that you called it played out as expected is because it did. Okay. If it didn't play out, if it went the wrong way, if it went against what you thought it would do, oh, well, that was invalidated. Okay. It doesn't explain anything. It just describes it. Well, that trend was strong. Okay, sure, fine. Was it strong for 10 points? Was it strong for 100 points? Was it strong for 1,000 points? What does that mean? So a lot of the time, if you can take one of these descriptions, and an easy way to kind of like, am I describing something or not? Or am I explaining it? Is, can you say the same from the other side or in a different situation? Oh yeah, that played out as expected. Okay, like bearish, bullish. Okay. Well, the trend was strong, or the trend was strong. Okay. Was it, why? Was it a long trend? Was it a short trend? Was it up? Was it down? Did it range? Are you calling a range a trend? So they don't do anything for us. What caused the thing to happen? Either buyers were willing to pay more or sellers were willing to pay more. That's it. Just aggression. Just one of two things. How do we fix this? How do we move into explanation instead of description? We have to be able to read the charts. We have to understand that it's entities agreeing on a price and entering and exiting the market, people buying and people selling, people being aggressive and people being patient. What were they aggressive? Were they pretty relaxed? Was there less volatility in the market because there were less people aggressively doing one thing or another? Was it because there were less people participating in the market, period, because it's 1 o'clock in the morning? So we can start predicting things when we actually understand the humans and the algorithms and the stuff that is happening beneath all of it on that granular level. So that's what we mean. That's what we should mean when we say we're reading the chart. Patterns and indicators are not without use, but they are not a replacement. Okay. Cool. So let's quickly, I'm not going to take a ton of time, but let's apply this. So I would like you to start making an effort to, I'd say every time you open a chart, I want you to run this little thing for yourself. So that you can get comfortable doing this, so that eventually you don't have to say anything. You can just look at it and all right, move on. So this is how we generalize. We need to be able to do this. So I want you to pick the last strong move that you find on a chart. I want you to describe it. I want you not to use the words resistance, support, trend, breakout, momentum, no descriptors. I only want explanations. And you have to say things like who was aggressive, what got consumed, where participants stepped in, even though we're not really using that term, but like where people decided to become more aggressive and then where that aggression ended. It's hard. I know it's hard. Like I wrote this and I even put in here, stepped in when I told you previously, don't use that. It's hard not to do. It becomes more okay to do when you really internalize all this stuff and you understand what you're meaning, because this is a shorthand where it's a lot easier when you actually know what's going on to say, oh yeah, I just broke that price level right there, because I know what that actually means. It's just easier to say this than go through this whole using who was aggressive and what got consumed, doing all that stuff, because you're already, you get to a point where you're just doing that in your head anyway. So fuck it. Yeah, man, shorthand it. Okay. So we're going to burn through this. I'm going to try to do this quicker. Again, this is everything that I've already done a bunch of times already, but this actually, you can see, if you look here, this was a trade of mine. I don't remember when it was or what symbol this is or what time frame it is, but at some point I threw it in here. So what you can see is I participated in the market here. I was a participant. I think I was probably a market order participant here, where I was waiting for price to come to me. But I might not have been. I might have been the aggressor here. I don't know. I don't remember. Overall, it looks like the buyers were more aggressive. So maybe I was aggressive here. Maybe I did click the buy button, the buy now button. So anyway, you have sellers that are more aggressive here, that are bringing price down to here. You have a lot of pushback here of buyers that consumed all those orders up to this point, even though there was a lot of aggression from the sellers here that drove price all the way down here looking for buyers, and then settled out here. And then we found this other level, which we'll get into a lot more as we continue, but you can find that this area will just kind of jump forward, was where the participants in the market found what they considered to be a fair value at that time. About in the middle of this, what we call a range, because there wasn't a lot of aggressive movement one way or another, because people generally were agreeing that this was a fair price. So both sides were about equally absorbing the buy and sell orders back and forth. So I entered the market here in a long position because I expected price movement to move up here, because I expected that buyers were continuing to be more aggressive than sellers at this time, at this price. I entered here and I waded through this market moving sideways, this area of fair value, until the buyers that were sitting here outlasted the sellers that were sitting here. There are the sellers thin out because they've left the market after selling their shares, and the buyers have to resume aggression to keep satisfying. We find another level here. Sellers become more aggressive. Buyers become more aggressive here. There was a lot of contention in these two candles. You can see that by movement, but very little for overall price movement between open and close. So a pretty strong level of fair value found here. And I have a resting order as I am waiting for price to reach a point that I choose to then exit the market. So I held here. I didn't panic. I didn't try to sell now. I just waited until I had a predetermined take profit level where I said, I want to be out of the market at this point. When price touches here, please close my position and take the difference in this spread. That was a total of 26 points, which is 107 ticks, which is a very small run. I will probably make other videos where I'm showing you a 1200 point run. This was just something I happened to do that I grabbed a snapshot of. This is a very small movement on certain symbols. Anyway, so there you go. That's what happened there. And then we found equilibrium here again, or we found fair value here. All right, let's work really hard as we're learning this stuff. Again, you can use these terms when you understand what you're actually saying. Instead of saying, oh, the trend did something, we could say the buyers were willing to pay more. They were the aggressors. Well, there was a breakout. Sellers were willing to settle for lower prices to find new buyers at a price level. There was a lot of momentum there, or momentum was stopped there. No, you had a large pool of buyers sitting at that have resting orders at a certain price level en masse that were absorbing the aggressive buyers or the aggressive sellers that were meeting them there. Support and resistance. The offer queue or the order queue ran out at this point. There were no longer buyers or sellers that were aggressively trying to buy or sell right now. Price wanted to. You have new people entering the market, new entities entering the market with new bids at whatever price. The market was feelings, vibes, whatever. No. Aggression ended when XYZ happened. Okay. Keep yourself honest. When you're doing your own chart talk, think about this. Can I explain this move without using descriptive crutches? Can we be objective? Can we explain? If you have to fall back on a trend or a breakout or something, you actually don't have an explanation. So that should be a trigger for you to say, what is it that I'm not understanding? What have I not analyzed so that I can explain this concisely? Okay. Can you name the mechanic that was driving something? Was it the buyers being more aggressive? Was it the sellers being more aggressive? Can you identify where that aggression ended? Not it hit a level of support, it hit a level of resistance. can you articulate based on the consensual transaction, series of transactions where the aggression ended for one side or the other? And could the same explanation describe the opposite thing? Pretty straightforward, right? Say it and then say it from the other direction. And if it could be applied both ways, you probably need to think a little bit harder about it. If the answer to any of these first three is no, 1, 2, 3, you're describing shit, you're not explaining it. Think about it a little bit harder. Use the first principles of why until you can find something that you can explain. And then if the answer to the fourth one is yes, then you really don't have an explanation yet. I believe in you. I know you can come up with one. It's just going to take a little bit more effort, maybe a little bit more of a cognitive load to decide what you're actually explaining. Okay. 3 things that we started off with that I want to make sure that we come back to. The market is just a continuous auction of buyers and sellers meeting at a price, filling their orders and leaving. All day, every day, big and small, all over the place. The chart is just a record of that auction as a lagging indicator. Candles describe what happened. They have no agency. The chart has no agency. The chart and the candles don't make anything happen. I would even argue, and I think I talk about it later, the news doesn't actually make anything happen. It affects the way buyers and sellers are buying and selling. It's people. It's always people, always people. And there's only 2 things that move price. People being aggressive when they're buying and price goes up. People being aggressive when they're selling and price goes down. That is the whole thing. Oops. So what are the things that you can do now that you couldn't do, an hour and 45 minutes ago? You can look at any chart and you can read it based on what buyers and sellers are doing. You're not memorizing patterns. We can go down to the individual transaction and explain what's happening and why. Therefore, we can scale up and continue to explain what's happening because we understood what happened at the atomic level. We can talk about this stuff. Hopefully, we're going to continue to practice to talk about this stuff casually because you actually understand what's happening, because you can actually explain things without using analogies as a blanket, descriptive language as a crutch to actually understand what's going on. So who paid, who settled, where did that aggression start, where did it end, and why? We can spot some narrative traps in the way we think about stuff, and we can start working to change that. So if you find yourself describing, pause, think harder, ask yourself why, until you get to your first principle, and now you're explaining something. And then you can now name the mechanic that is driving every single thing that happens on a chart, on a candle, everything that you see. Buyers paying more, sellers accepting less. It is one or the other, buying or selling. I'm super proud of you guys. I'm super stoked. I hope this was helpful, and I'm just going to keep rolling. I've got quite a few of these planned for you, and if I only help one person, totally cool. Okay. I now think you guys are ready for module 2. So that is where we are going to dig much deeper. We're going to look further in on participants in the market, the order books, the different types of aggression, the fair value gaps. It's the same auction. We're just going to zoom in more. And that's what we're going to keep doing, is we're going to keep building depth of knowledge on top of what we already understand. So we're going to meet the 4 populations. Again, I have my little notes over here. We're going to meet the 4 populations of participants in the markets. And we're going to discuss why they're different and they have different time horizons and how that can cause what appears to be disagreements between different time frames, between a 5-minute time frame and an hour time frame, or charts. We're going to look at the actual order books in depth and the resting bids and asks and how the aggressors transact against those things. We're going to learn about more of the vocabulary around aggression, which is there's 4 levels to it. And that is going to let you read the pressure that's being applied in real time based on the level of aggression. And then we're going to add concepts about fair value. We're going to talk about the two different regimes that happen, balance and imbalance in the market, with participants in the market. And that's going to determine which playbook that you're going to want to use when you are making your decisions. Everything in module 2 built on module 1. And if anything in this feels shaky or anything in the next module feels shaky, go back. And this will be here forever. And as we move forward, if you're missing stuff, it's just like anything. Like when you go to math class, right? Like you have to understand, addition and subtraction before you can do multiplication and division, before you can do, algebra, before you can do geometry, before you can, you know what I mean? So you have to understand the thing before to build on the thing next so that we can continue to explain instead of describe. Super proud of you guys. I hope you got some value out of this, and I will see you guys in the next one.